the brokerage industry, and unfortunately, futures markets really never close. I know people think, the stock market's closed, so everybody's job is done, but that's not necessarily true if you are a futures broker. So anyway, today we are going to talk about, to be 100% honest, I haven't listened to the previous presentations. I've been working, but my guess is they're probably, the content's probably a little different than what we're going to talk about today and over the next hour. We're going to talk about what an elevated VIX does to the option market and how maybe you could use that to trade the VIX indirectly, maybe in a more, a less volatile or stressful way is really the goal that we're going for. So we're talking about how an elevated VIX creates attractive option opportunities. And this is actually a great week for that, because with the election coming up and the stimulus issues we've got going back and forth, volatility is relatively high, and so are option prices. And so we're going to talk about some ways to trade spreads that might give you a chance to get into the market without a whole lot of stress, or at least that's the idea. Of course, you can never predict what's going to happen, especially on election night, but we'll take a look at some trading examples and give you some thoughts here. If you don't know who I am, my name is Carley Garner. I am a futures and options broker. I'm located in Las Vegas, Nevada. I know that most brokers are located in Chicago, but the weather's better in Nevada, and so that's that. If you're on social media, you can check us out on Facebook, Instagram, Twitter. We do post a lot of market commentary, charts. We try to keep things pretty fresh as far as the market info goes, but I also do love to post pictures of my dog. So if you're not an animal lover, you may want to stay away. But this is Frankie. This is, believe it or not, this is 20 minutes outside of my home in Las Vegas. So this is, I know when people think of Vegas, they think of a desert and that type of landscape, but guess what? We have mountains too, and it's actually pretty beautiful here. If you're not familiar with some of the things that we do, I've already mentioned I'm a broker, but I'm also an author and a strategist. I provide content to Jim Cramer's Mad Money. I also provide content to Bloomberg Television about once a week, the Options Insights segment with Abigail Doolittle, and I do write a column for Stocks and Commodities magazine every month. I also write a couple of newsletters for our brokerage clients, the DeCarly Perspective and the Financial Futures Report, that do offer trading ideas and market perspectives and things like that. I've written multiple books. If you go to Amazon, you're going to see probably 6 or 7 books, but ignore everything except for these 3. These are the only 3 that you need to know about. The others were a previous publisher. They're out of date. They're out of print. They're crazy expensive. Don't do that. Everything you need to know are in these books. At least this is the fresh, pertinent content. So the newest is Trading Commodity Options with Creativity. We released this book a couple of months ago, and so far the feedback's been pretty good. Some of the trading ideas that we're going to talk about today are in this book in much more detail, obviously. Before we get started, I just want to make sure that everybody understands trading is risky. There's no guarantees you're going to make money. It's not suitable for everybody. I do believe that it's probably not suitable for most people. Trading can be, it's a mental game, and just like not everybody's capable of being a surgeon or a police officer or an athlete because of the mental aspects of the job, not everybody is capable of being a trader. It's definitely not easy. There is a substantial amount of risk, of course. There's the full disclosure. So volatility is the hot new asset. Everybody wants to talk about trading vol, whether it's through the VIX or an ETF that tries to mimic the VIX, or through option trading. Everybody wants to trade and talk about vol, but I can honestly tell you, trading volatility is probably one of the dangerous asset is probably not the right word to use for volatility, but we'll call it an asset just for simplicity. It's probably one of the most dangerous assets to trade, because we're dealing with, it's basically, in a nutshell, it's emotion. We'll talk a little about that. but I'm sure that you've gone over the definition of volatility, so I'll be real brief on this. But the idea is if you're talking about volatility within finance, it's basically the standard deviation, right? It's the statistical measure of dispersion between highs and lows for any particular market. That's volatility. Or in simple terms, it's defined as the ability to rapidly and unpredictably change prices, and especially for the worse. When people think of volatility, they generally think of negative volatility. So in the stock market, when we talk about volatility, we're talking about the stock market going down. Of course, in general, volatility can go both ways. The market can go up sharply, and that's volatile. But when most people are throwing the word around, that's what they're talking about. So one of the reasons that playing volatility or trading volatility is dangerous is because we're talking about something that's completely unpredictable. And I'm not saying that other markets aren't unpredictable, because they are. But volatility is, in a nutshell, human emotions. That's really what it is. And humans are illogical. We are ourselves volatile. We're unpredictable. So the stakes are high and the certainty is very, very, very low. There's absolutely no certainty in market pricing and volatility. And to put this into perspective, when people talk about the VIX, what we're really talking about is implied volatility, right? It's the amount of premium that's built into S&P option prices according to what speculators or traders are assuming the volatility to be at some point in the future, whether it's today or next month, whatever the case is. Speculators are pricing in higher or lower levels of volatility based on their expectation. And these prices are very vulnerable to emotional spikes. For example, in March when the S&P was crashing and volatility was spiking, a lot of that volatility was simply because people couldn't take the pain anymore. So they were purchasing puts at insanely high levels, put options that the odds of them paying off were slim to none. People were buying them because it was emotional. So emotions get carried away, so do market prices, so do option prices, as well as the VIX. So the VIX in itself, when you're talking about trading the VIX directly, it can be a little confusing because there are VIX Futures, which trade on the Chicago Board of Options Exchange, and right there is just an odd sentence to even say. The CBOE is an option exchange. In fact, it's a stock option exchange. It's not a commodity option exchange or a futures option exchange. The VIX is the only futures contract that that exchange lists. And what's even crazier is the CBOE lists options on the VIX, but those options are stock products. They're not written against the VIX futures. So if you're trading VIX futures, there's no way to directly hedge it. So for example, our clients are pretty big generally on hedging their futures positions with options and vice versa. You can't really do that with VIX futures. You're either long or short the VIX future or you're not, and that's it. There's no way to sell calls against it. There's no way to buy puts against it, so on and so forth. Now, you can get tricky, and I've talked about in other webinars in the past that you can trade S&P options around the VIX future, but it's a hedge, but it's definitely not going to be, it's not going to work out exactly how you want it to be, because ultimately, while those two products are related, they're still two different products. And so you can, sometimes your hedge is going to work out as expected and sometimes it's not. Also, you're dealing with different notional values. So you're either overhedged or underhedged. So there's all kinds of variables there when you're trying to use S&P options, or E-mini S&P options, I should say, to hedge VIX futures. So that's a tough game. And anybody that's traded VIX futures outright knows you can make or lose a lot of money in a very short amount of time. It's the kind of market that's a sleeper most of the time. But when it does make a move, it makes a dramatic move. So dramatic that if you're on the wrong side, you're probably toast. Hopefully none of you have experienced that. So most people are aware of the VIX, they just aren't aware of the intricacies. As I mentioned, they're not aware of the fact that if they're buying calls and puts on the VIX, they're buying a stock product. But if they're buying or selling the VIX futures directly, that's a futures product that cannot be hedged with options. So again, it's a little bit complicated, and you really shouldn't underestimate those details because it can make a really big difference. Even if you're normally just a futures trader, if you find yourself in a hairy situation and you want the ability to hedge with options, it's going to be really tough. Also, the margin on a VIX futures contract, the last I had checked, is almost 14,000. So the margin's very high. So the idea of hedging your futures with options is one way to help mitigate the margin impact. And if that's not available to you, it is what it is. You either have the 14 grand to pony up for margin or you don't. Even if you do, you're still going to experience quite a bit of volatility, and that's not necessarily pleasant. So again, when you're trading VIX futures, you're basically directly trading human emotions. During times of complacency, the VIX falls. It almost acts like an option contract. In fact, it is kind of an option contract in that it erodes over time. When investors grow emotional, the VIX rises, obviously. Another thing to keep in mind that most people don't incorporate into their mindset before they put a trade on, which is unfortunate, because the VIX futures trades on the CBOE, not the CME or the CBOT or any of the other futures exchanges that most people are used to dealing with. The CBOE has different rules. There's different hours. There are different times of day that certain order types can be used. To be 100% honest, it's been a little while since I've checked to make sure that nothing's changed. But the last I had checked, you couldn't enter market orders during the overnight session. You could only enter with limit orders. The stop orders couldn't be straight stop orders. They had to be stop limit orders. And there were different times in which these different orders can be accepted or not accepted. So it's quite a bit more complicated to trade VIX futures than it is maybe an E-mini S&P future. So again, know your product. Too many times traders get into a product or into a trade and then they try to call their broker and ask for the specifics, but by then it's too late, to be honest. You really need to know what you're trading, what are your risks, what are your rewards, what are the hours. Simple things like that can make a really big difference. The VIX is obviously not an investment. It's a trade. It's a highly speculative, no mercy trading vehicle. It should never be looked at like a stock or a bond investment. And maybe even not even like any other futures contract. It's much different. But similar to other futures contracts, there's no dividends or interest. You're long or you're short, and your speculation is either paying off or it's not. It's really that simple in the VIX. I'm sure that you remember in 2018, it was early 2018, there was a hedge fund that blew up. Their strategy was simply to sell the VIX, and it worked for a long time because volatility continually went down. When it did spike up, it was relatively short-lived, and we all know what happened next. When volatility came back, it was only temporary. Volatility literally only came back for 2 or 3 weeks at the very most, maybe even less than that. But that's all it took to wipe out a hedge fund, and actually probably a couple of them. So it really is a no mercy type of product. And it's not one you should get complacent with. I don't have it in this slideshow, but in previous webinars that I've done, the VIX is actually a snoozer 90% of the time. It trades very quietly, under 20 most of the time, many times between 10 and 15. Sometimes it'll stay between 10 and 15 for years. And then suddenly, like we've seen in March of 2020, it makes a massive move to the upside. The problem is anybody that was long the market, waiting might have ran out of patience or money, because remember, the VIX is an eroding asset, just like an option. It would be almost like buying S&P put options for 2 years, waiting for the move to happen. And if you did that, you probably either missed the move because you ran out of guts by the time the move happened. Maybe you ran out of money, who knows? And if you were short the VIX, just like selling puts in the S&P worked out, might have worked for 2 years, but 1 week in mid-March, it didn't work, and that's all it took to wipe everything out that you took a couple years building. So there's a lot, even if you go to the CBO website, by the way, the CBOE website, it even says in big bold letters. Now regulators probably encourage them to put this there, but I'm glad that it's there because really people need to know. The VIX is not a buy and hold market. It's not a buy and hold asset. Now, if you're looking to buy for a month or 2 months, that's probably fine. But if you think you're going to buy for 3 years and just hold it and keep rolling it over until something happens, you're going to be sadly mistaken. Even if eventually the market does go up, you're probably just getting the money back that you lost. And this is because if you look at the CBOE's VIX index, the one that's not necessarily traded, just one that traders use as a fear guide, it might trade at 10 to 12 to 15 for years and it looks like it's not doing anything. But if you're holding the futures contract, you're always paying the contango or the difference. So the distant months in the future are always going to be, not always, I shouldn't say that, but are often priced higher than the front months. So as you're rolling out into new futures contracts, you're constantly paying a little higher price. And then the VIX is slowly eroding just like a long put option would until you roll over again. So it's not something you want to buy and hold forever. If you think the market's going to make a big move and you want to be long the VIX for the next month or two, okay, that's probably reasonable. But beyond that, you're going to really start eating yourself up. The VIX, we're going to talk more about options going forward. But just to clarify, there are actually 2 VIX futures. There's a full-size VIX, which is the one that everybody's familiar with if they've ever traded VIX futures, and it's a really big contract. Like I mentioned, it's about 14,000 a margin. Each point is worth $1,000. So if the VIX goes from 30 to 31, you made or lost $1,000. The great news is, a couple of months ago, without a lot of effective marketing, because to be honest, I didn't hear about it until just a few weeks ago, but there is now a mini VIX, which I think is fabulous because the mini VIX is 1/10 the size of the original. It's kind of like if you've ever traded the S&P, the E-mini S&P now has a micro S&P, and the difference is the micro is 1/10 the E-mini. This is the same thing. The mini VIX is 1/10 the size of the traditional VIX futures contract. This gives speculators a much better opportunity to get into these trades without risking a big chunk of their account if they're wrong. So the mini future is $100 per point. Probably not going to get rich on it, but let's say that the VIX is trading at 25 and it goes to 26, you made $100. The great thing is, if you are long the VIX from 25 and it goes to 20, you're only out $500 instead of $5,000. Most people can live with $500. 5,000 starts to get a little stressful. So again, that's a new product. And by the way, I should mention, we do offer that product at our brokerage. From what I can see, not all brokerages do offer it. So depending on who you're trading with, you may or may not have access to it, but that might be worth asking your broker about because that's an awesome product. So rather than trading the VIX outright, maybe it makes sense to think outside of the box. When volatility is high, as it has been in 2020, there are opportunities that normally aren't there. Or if they are there, they're not nearly as attractive. And this is because higher option premiums can be used to create spreads with wide profit potentials, relatively small risk, and big profit payouts. Now, option trading isn't perfect, and we're going to talk about all the advantages and disadvantages, but this is just something to think about. Maybe not everybody's personality is equipped to trade VIX futures. And if you're a little more risk averse and trading futures stresses you out and you find yourself staring at the screen tick for tick, maybe this is a better alternative. You know, I don't know, everybody's different. You have to find what works for you and what you're comfortable with. If you've looked at purchasing options lately, you know they're really, really expensive. The higher volatility and the expectation of volatility going into the election has kept option premium really fat. So if you're looking to buy a call or buy a put, hoping that if you pick the right direction, you're going to make some money, it's a tough game. you might, if your timing and your direction is absolutely impeccable, you might make some money, but they're so expensive that the market has to move dramatically just for you to break even on these options. So the higher volatility make it really tough for option buying, at least profitable option buying. But on the flip side, selling naked options in this environment going into the election probably isn't the best way to go about it. That's a little bit scary. So maybe taking the best of both worlds might present low risk plays with potentially high rewards. And that's kind of what we're going to focus on today. The first trade we're going to talk about is the option butterfly, and then we're going to talk about ratios, which is just an adjustment of a butterfly or a different version of the butterfly. Butterflies provide opportunities for low and limited risk range trading in a high volatility environment. The great thing about high volatility and high VIX is expensive options. An option butterfly involves buying two options and selling two options. Because you're selling options, the high premium isn't such a big deal, because although you're paying top dollar for the options you're buying, you're collecting top dollar for the options you're selling. So it ends up kind of washing out somewhat. Also, if you're not familiar with options, anytime that you are buying or selling the same number of options of the same type, you're going to have limited risk. So if you're buying two calls and selling two calls, your risk is going to be limited no matter what your strike prices are. Now, depending on how you arrange those strike prices, your risk might be very large, but it will be capped. If you're buying one option and selling two options, you have unlimited risk. Your margins are going to be higher and your risk is going to be extremely high if something weird happens. We're going to talk about that as well. I'm going to show you both types. So butterfly is the act of purchasing. Let's start with calls first. Purchasing a call option that's relatively near the money, selling two out of the money calls, and then buying another call equidistant, so the strike prices are the same distance from each other, and that last call caps your risk. That prevents you from having unlimited risk. Now it's going to cost you, but you can get into a trade because you're selling two and buying two. You can get into a trade relatively cheap with a really high profit potential, usually, not always, but in this environment with the VIX elevated, you can. Now they're not perfect. Butterflies are not perfect because you can be too right. You're basically range trading with a butterfly, and the range might be wide, but regardless of how wide your range is, if the market lands outside of that range at expiration, you've lost money. You've lost whatever you paid to get into that trade. Also, you can feel handcuffed into a butterfly. Even if the market goes the way you think it's going to go, even if the futures price gets to the middle of your range trade where you're supposed to be making the most money, you may not have a profit. And that's because the material profit doesn't really emerge until closer to expiration. We're experiencing this we have a natural gas put butterfly on that we had recommended for our clients. And natural gas went the right way. It went exactly to the price we thought it was going to go to, but the spread itself didn't really make money. Now it still can, we still have time to expiration, but that's sometimes frustrating. And it's not always like that. Each situation is different, because just like S&P options have implied volatility, so does natural gas. The natural gas market just happens to be keeping a lot of implied volatility in the options. Hopefully that'll come out, just like perhaps in the S&P after the election, we'll see some of the implied volatility come out, and that'll normalize some of these spreads. But unfortunately, that's just part of the game. The other thing to consider with option butterflies, I'm going to throw some numbers out here as we go through these slides, and you're going to think, wow, for such a small risk, you have such a high profit potential. That's great. And it is great, but the maximum profit potential is a low probability event. The odds of the market being right at the center of your strike price at expiration is pretty slim. And even if it is, you're going to have to hold almost all the way to expiration to get that profit. So it's not quite as exciting as you think it might be on the surface. But this is a way to get into the market for cheap and limited risk, and that's hard to beat. Also, with a spread like this, even though the maximum profit isn't necessarily super likely, some profit is relatively likely, because if you're just kind of right in the direction of the market, you should come out ahead. Okay, so this is what an order ticket might look like for a call butterfly. This is in the E-mini S&P using the December options. This is just a hypothetical example of something you might look to do maybe ahead of the election, or in some other time frame that the volatility is high like it is today. Sorry, this is the put side. I thought I was doing the call side first. So the idea is the S&P is trading roughly, this was taken a few days ago, by the way, but the S&P hasn't really moved since then. So the S&P is a little above 3,400, but this is buying a put that's relatively near the money, the 3,400 put, selling 2 puts beneath that with a strike price of 3,250, and then buying a 3,100 put below that. So the net result of this monstrosity is we're paying about 12 points in the S&P, which each point is worth $50. So I'm just going to round. I mean, you can see it's 12 and a quarter, but let's just round it. So you're paying about $600 to get into this spread. For $600, your spread's going to make money roughly between 3,400 and 3,100. So that's a 300 point range that you can make something or get something back. Now you have to keep in mind you're paying 12 points to get in. So your break-even point is 3,412 points on the downside, and your break-even point on the other side is, I'm sorry, not 3,412. I keep thinking calls for some reason. So it's 3,388 is where you break even. If the S&P is at 3,388 or 3,112, you make something. If it's anywhere in between, you make something. If the market's right at 3,250 at expiration, this trade expires in roughly 60 days. Again, I'm kind of rounding, but you get the idea. If the S&P is trading at 3,250, that's the maximum you could make. And you're going to pick up the spread between 3,400 and 3,250. So that's 150 points minus what you paid to get in, which is 12. So you net 138 points, or $6,900. So your total risk is $600. The most you could make is almost 7,000. So you can see how it's easy to get excited over these sorts of things because your risk is little, your profit zone is really big, and your payout is really big. This is what it might look like on a chart. Now, again, if you're wrong about the direction, you're going to lose money. You're going to lose your $600, but I think 600 is a reasonable wager. If the market's above 3,400 at expiration, you lose your $600. If it's below 3,100 at expiration, you were right about the direction, but you were too right. So you still sustain the maximum loss of 600, and that's frustrating, obviously. But anywhere from roughly 3388 down to 3112, you make something. So all is well. Now again, I'm going to make sure you understand this. If the S&P drops to the middle strike price of 3250 tomorrow, it's going to be really exciting because you're thinking that's in my profit zone and I should be making all this money. You're probably not going to really be making anything at all. This spread might be up $100, maybe at the most. And that's because the volatility is going to be really high. It'll be even higher than it is today, most likely. If it takes the S&P 60 days to get to 3250, this spread is it's going to make you look like a genius. So just keep those things in mind. It's not a perfect way to trade because of time value erosion, being handcuffed in the trade. But how many trades can you do with a $600 risk and no stress and have, even if it's a little bit of a crapshoot to get that kind of money out? It's still hard to come by if you're trading futures or anything else. Now, I should also disclose that in 2019, you would have never been able to put a spread like this together. And that's because the options were a lot cheaper. If you wanted to spend about $600 on a butterfly spread in 2019, I mean, I'm not looking at, I don't have numbers to go off of, but just off of memory, you're probably, instead of a 150 point spread, you're probably only looking at a 50 point spread. So instead of your profit potential being $6 to $7 grand, it might only be 2,500, which obviously, you know, still that's not horrible, but it's just we're just dealing with a different ball game in 2020 than we normally are. And so these types of trades look a lot more attractive than they normally do. So we can do the same thing with the call side. We all know in the S&P, stock market tends to go down faster than it goes up, although that theory has really kind of been put to the test, but I think we can still agree that's the case. And the market knows that. So the puts tend to be more expensive than the calls. Because of that, you can't get off the same kind of spread on the call side than you can the put side, but it's still pretty attractive. So on the call side, and again, this is just for educational purposes. I'm not saying you should go out and do this. This is just to give you some ideas. But on the call side, you could buy the December 3,500 call, sell the 3,600 call, sell two of those, by the way, and then buy the 3,700 call. Again, because we're buying as many options as we're selling, the risk is limited, and the risk is limited to what we pay to get in because our strike prices are equidistant. Now, if we had a lopsided butterfly, let's say that we bought the 3,500, sold two 3,600s, and then sold and then on the last leg we bought a 3,750 or a 3,800, we could do that, but our risk would be a lot deeper. In this particular example, if we pay 17 points for the spread, that's $850. So that's the most you can lose is what you pay to get in, plus transaction costs, of course. And keep in mind, this is for commissions. So that's something you just have to be aware of. They are transaction fee heavy, but again, no strategy is perfect. And the idea of this is you get into the market with low risk, limited risk, and honestly, you can sleep well at night knowing that you're in pretty good hands. Even if you lose everything, it's not going to ruin your life, hopefully. This is what that trade would look like on a chart. So it's the same general idea, but to the upside. So if you think the S&P is going higher, not lower, you could put something like this together. You're risking $850. Again, this is hypothetical, but these were real prices, so it was possible at least a couple days ago. I think premiums have come down just a tad, so might be a little different now, but it's probably not too far off. But anyway, the most you can make is 41.50. Still, that's a pretty good risk-reward ratio, but again, I'll remind you, it's not quite as exciting. The odds of you getting the 41.50 out of this trade are pretty slim. Even if you hold, let's say that you, on the morning of expiration, and this actually happened to us, can't remember, I think it was last month's expiration or maybe the month before, but anyways, it was recently. We had recommended a butterfly and quite a few of our clients were in it. The payout for the max, the maximum profit on that spread was in the thousands. Again, I'm going off memory. It was maybe $4 or $5 grand was the max payout. But in the morning, the spread could only be sold for a profit of maybe $1,500, $1,000, somewhere in there. Again, just totally ballparking it. But a lot of clients decided they wanted to hold to the close because they were thinking the potential on this spread is $4 or $5 grand. Why would I sell it for $1,000 this morning when I only have 6 or 7 hours to go to expiration? And I can absolutely understand the thinking in that. However, in a market that's moving this quickly, and especially on expiration days get really, really extremely volatile. So just because the market in the morning is sitting at your max profit price doesn't mean it's going to be there in the afternoon. And in this particular case, it actually wasn't. I think the spread ended up expiring worthless. So be really careful with that. You don't want to get greedy. If your risk is low and you can turn a nice, respectable profit out of it, just take it. Don't try to squeeze out the last few pennies. Or even if it's a substantial difference, like for example, a couple thousand in 5 hours, don't get greedy because the market, what it gives, it can take away even faster. So you might be asking yourself, what if you don't know what's going to happen after the election and you don't know which way the market's going to go? And I think we're all in that boat. I know that some of the pundits on TV are claiming they know who's going to win and that the market's already priced that in, but I'm not so sure that that's how it's going to pan out. So if you're not so sure, you may want to consider putting a spread like this on both sides of the market. Of course, when you're spending money on both sides of the market, even though like both trades are relatively cheap with high profit potentials, if you add those two premiums together, it starts to be a little more expensive, right? So if you bought both the call spread and the put spread, it'd cost you about 29 points in the S&P or $1,400. So suddenly your risk is a little bit bigger. But the idea is you have the ability to make money on both sides of the market. And I think we can all admit we all probably have opinions on what we want to happen or what, but we have no idea. I mean, all we can do is wait and see. So the maximum profit on the trade is reduced because we're spending more premium, because we're not only purchasing the put butterfly, but we're also purchasing the call butterfly. So any profit that we make on one side or the other, and by the way, we're not going to make money on both. One's going to lose and one's going to make. That's just how it works on a spread like this. The profit is reduced by the amount of premium that we paid. So if the market goes down, the most we could make if the S&P is at 3250 would be roughly 6,000 or 120 points, because we're paying roughly 30 points to get into that spread, to those spreads, I should say, to both spreads. On the upside, we might make as much as 3,500. Again, still not too bad, but now you have to look at the risk reward. We're spending roughly 1,500 to make maybe 3,500 or maybe 6 grand. Those are still really good numbers, but we have to ground ourselves knowing that the odds of getting the max profit are not great. In fact, they're slim. So the great thing about the trades that we just talked about is they offer limited risk. And there's no stress. You know what you're risking, you know what you can make, and there's really nothing else to worry about. You just wait and see. However, it is pretty expensive to purchase that last option. In the first spread we were looking at, it was the 31 put that we purchased. Anyway, the point is you're spending a lot of money to buy that extra protection so that your risk is limited. If you have a big enough account to finance this trade without the protection, it might be something to consider. Now, it does leave you open for open-ended risk, but that open-ended risk is extremely far from the current market price. We're going to show you a specific example. So the great thing about not purchasing the insurance is instead of executing the two trades as a debit, meaning we're paying money out. Remember, we had to pay $1,500 to buy both spreads in the last example. But if we don't buy that last option and we don't cap the risk, we're actually collecting money to put those trades on. So we're receiving a premium credit as opposed to paying a debit. This also widens the profit zone and increases the odds of success quite a bit, because your profit zone is now much bigger, and even if both spreads expire worthless, you collected a premium, so you still make money from that. In other words, it gives you two ways to make money, either through the premium collection, through the direction of the market, or both. The downside, again, is theoretically unlimited risk. However, anytime, most people don't understand this. People are scared to sell options because of the unlimited risk. But the reality is, whether you have a short put or a long futures contract in the S&P, the risk is really the same. In fact, it's a little less on the option because you're collecting money up front that cushions it's basically acts as a risk buffer. That said, I do fully understand that if you're long a futures contract and something goes wrong, it's quite a bit easier to liquidate, because you don't have to worry about there being a bid ask or someone there to take the other side of your trade. There's always someone there to take the other side of a futures trade. In options, occasionally, not often, but occasionally, it can get a little hairy when it comes to liquidity. The bid-ask spreads can blow out. So there is some risk there to think about, but those types of things really only happen once every couple years. It's not something that happens every day. Also, in a futures contract, you can place a stop order. Options, you can't. So there's definitely some things going on here. But the reality is when we buy a futures contract, our risk is theoretically unlimited. Same as selling a put and vice versa. So this is what it might look like if we did ratio spreads rather than butterflies. So instead of purchasing the extra call option and the extra put option to cap our risk, we're simply just collecting premium and hoping that the market doesn't do something extremely out of the ordinary. So in this particular trade, our risk is unlimited above 37.50. Well, let me specifically read out what we're doing here. We are buying the 3,500 call in the S&P. This is December. Selling two 3,600 calls. That creates a ratio spread up above. We're then buying a 3,400 put and selling two 3,250 puts. We're collecting roughly 49 points or 25. Well, I'm just going to round it to 50 points. We're collecting roughly 50 points, which is $2,500 in premium. If the spread expires worthless, I think you can see this, my cursor here. If the spread expires worthless, if the futures price is between 3,400 and 3,500 at expiration, you keep all the premium collected. So you would make $2,500 even though the market didn't move at all if it just stayed here. You just get that for being involved in the game and accepting the risk of the market blowing up on the upside or downside. If the market goes up, your max profit potential on the call side, remember, because of the way options are priced on the call side versus the put side are a little different, our spread is tighter on the call side. So our maximum profit potential on the calls is less than that of the puts, but in any case, it's still very high. And again, we're going to run into the issue, the odds of you getting the maximum profit are not extremely high. They're very low, but if you can get somewhere in the vicinity, I think we'd all agree that would be very, very awesome, or that'd be a successful trade. By the way, the margin on a trade like this is about $8,500 right now, and that, the exchange is charging quite a bit of margin on the S&P because, let's face it, it's been a crazy year, and anybody that's been under margined or over leveraged has had some trouble. All right, sorry about that. I had to take care of something real quick. So the maximum profit on the upside would occur if the S&P is trading exactly at 3,600 at expiration. And that amount would be 149 points or 74.50. And how we get to that number is there's 100 points between the strike prices. So as the market's traveling from 35 to 36, the trader picks up 100 points. Also, you collected 49 or 50 points to get into the trade. So at this particular price right here, the spread has its maximum value. The 3,600 calls basically expire worthless. Your long 3,500 call is worth 100 points, and you collected a total of 49 points to get into this spread as a whole. So the trade would pay off roughly $7,500 before transaction costs, etc. On the downside, it's even more lucrative, assuming that the S&P is trading exactly at 3,250 at expiration. The trader would make 150 points intrinsically because from 34 to 3,250, the trader's making money on that spread. He's long one, call, and short two. He's long one put and short two puts. Those two short puts would expire worthless, and he would keep the premium that he collected as well as the 150 points in favorable price movement. The max profit on that side of the trade would be roughly 10 grand. So again, the market's paying you $2,500 and you can make maybe 10 grand on the downside, maybe 7,500 on the upside if everything went perfectly. And if things go sideways and don't go anywhere, you still make $2,500. So it's all gravy. Now here's the downside of this. Above these points that I'm pointing at here, you start giving money back. So on the upside, if the market gets above 3,600, now suddenly you're still long one call, you're short one call, but I'm sorry, you're short two calls. So you're actually giving money back beyond 3,600 until you run out of money at about 3,750. You break even at 3,750. So at 3,750, you don't make anything. If it goes above 3,750, you're losing money. Above 3,750 is like being short a naked futures contract, and you have unlimited risk. The same thing below 3,250, you start giving money back. You run out of money at 3,050, and then at that price, it's almost like being long a futures contract, and you have unlimited risk on the downside. So as long as the market stays above 3,050 and below 3,750, you make something. If it stays between 3,600 and 3,250, you make a lot. The risk is if something really out of the ordinary happens and the market goes up too much or down too much. So again, this is not an official recommendation. I'm just giving you ideas, and hopefully it'll help you with some of the things that you're doing in your accounts. So in conclusion, I'd just like to try to kind of recap some of the things we talked about. Obviously, it's impossible to teach option spreads in 45 minutes. This is my recent book, or my latest book, Trading Commodity Options with Creativity. It's about, I want to say it's about 380 pages. So it's let's put it this way, it's a $40 book disguised as a $20 book, because we sell it in paperback for 20 bucks, and there is so much information in there. And it actually, I had to cut a lot of it out because it just became too much. So my point is, there's like an unlimited amount of material that we could cover when it comes to option trading. There's just no end. And I found that even as I was writing the book, I was learning and experiencing things. Ironically, I was writing the book in early 2020 during all the chaotic things that were going on with the crashes in crude oil and so on and so forth. And so I learned a lot of really tough lessons, and I tried to portray that in the book, and hopefully other people learn from them as well. So here are the main points, hopefully, that you got out of today's class. Trading the VIX directly is a roller coaster ride that some traders are not equipped or funded to handle. The VIX erodes like an option. So if you're long the VIX, it's susceptible to erosion, a lot like being long S&P puts. If you're short the VIX, it's the opposite. It's kind of like being short S&P puts. You'll make money if nothing happens, and time value erosion works on your side. Now, I should have mentioned, being short the VIX works most of the time. Being short S&P puts works most of the time, but it's the small percentage of times that it does not work that has the ability to wipe everything else out and make it, honestly, doesn't matter that it works most of the time, because when it doesn't work, it really doesn't work. So just be aware of that tidbit of information. Because the VIX is loosely translated as implied volatility, a higher reading in the VIX infers overpriced options, and then potential for higher profit potential per risk of unit, or per unit of risk taken. So like the butterfly spreads that we showed you earlier, because the VIX is high and because the options are priced accordingly, you can put together some butterfly spreads that are wide, cheap, and have high profit potential. I try to encourage people to be creative with option trading. you can do just about anything you want to do as far as a risk reward profile with options, as long as you're creative. You don't have to do things by the book. For example, the spreads that we talked about a few minutes ago, the butterflies, we can peel them apart. If the market doesn't go our way, we can buy back the short legs and hold the long legs. There's all kinds of different things you can do with options to help them perform in the current market condition. Now, if you're just dead wrong in the direction or the timing, then there's nothing we can help you with. But if you put on a spread and you're temporarily wrong, maybe you're just early, you always have a foot in the door, and there's always a way for things to get better. But there's some adjustments you can make that put you in a better position to do that. Those are some of the things that we talk about in my book. One thing I didn't point out earlier, and I should have, is when you're trading the VIX outright, you're probably using stop loss orders. And if you're not, eventually you're going to get caught on the wrong side of a move that you just simply can't come back from. But the problem with stop orders is once you're stopped out, you're out, and it's hard to recover. Sometimes you're stopped out prematurely. You might be stopped out at the very worst time, the very high of the day or the low of the day. If you're using option spreads, you don't have to worry about getting stopped out. You might be wrong and you might lose some money, but there's always going to be a chance for that to come back for you. So if you're interested, I appreciate everybody coming today. I hope that you learned something. If you're interested in learning more about our services, our brokerage services, or even just learning more about trading, please visit TradingResearch.com. There are several videos on the website that are free to access. There's also articles. So if you want to learn for free, go to our website. If you want to learn more about option trading and putting together spreads similar to the ones that we talked about today, my book, Trading Commodity Options, is, in my opinion, a great resource for that. And the website's TradingCommodityOptions.com. And my friend Jim Cramer did offer some positive feedback on the book. So of course I was quick to put that on the cover, so that was fun. If there's anything that I missed, or if you have any questions that you think of later, feel free to send me an email, cgarner@decarleytrading.com. Again, visit our website or check us out on social media. We'd love to hear from you.
Hey, Carly, thank you so much for the presentation today. And guys, you can also see Carly in action. She has a segment off the charts with Jim Cramer on CNBC. You could also see her on Bloomberg, on Thinkorswim, and many other financial media outlets.
Thank you. It was fun. I appreciate the invite.
Thanks so much, Carly. Okay, any questions? David has posted the link for the book.
Thank you.